Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Wayne Penello. He is the founder of NextGen EMP. They recently launched the NextGen Efficient Market Portfolio Plus ETF, ticker EMPB. It's a long-short equity ETF designed to really actively manage systematic market risk using a proprietary and really a statistically driven methodology, as Wayne describes as a foggy ball. I thought this conversation was really interesting. They've done a great job here recently with all of the volatility, but I'll let Wayne explain to you the strategy and how it all works. So without further ado, please welcome Mr. Wayne Penello. Hey, Wayne, welcome to the show.
I'm thrilled to be here, Brad. Thank you so much for asking me.
So before we get started, why don't you give everybody a bit about your background and how you eventually decided to become the founder of NextGen EMP?
Well, I think the most relevant part of my background is the 40 years I spent as a commodity trader. It was 10 years on the floor of the New York Mercantile Exchange, where I was ring chairman of options. And then I moved upstairs to advise global trading companies like Vitol on how to manage the risk in their portfolios. And then around the year 2000, I started a consultancy to design and maintain hedge programs for companies, because it was obvious to me that people weren't focusing on the right elements to manage risk properly. And I eventually patented that methodology. It's called the Performance Risk Management System. And our clients using the Performance Risk Management System were paid over $13 billion for hedging successfully. That caught the attention of Forbes Books, and they approached me, and I published that methodology in a book called Risk is an Asset that's available on Amazon. I don't own the rights to it anymore because shortly thereafter I sold the company to one of my competitors, and they wanted everything. And I was actually very glad to have them, because I've been doing this for a long time, and took the winnings from selling my business and looked around at the equity space and said, okay, who am I going to get help me manage this while I go into retirement? Well, I couldn't find anybody I trusted. And the main reason was that in equities, they don't manage risk. They diversify it away. And the problem with diversifying it away is it means some portion of your capital is getting equity style returns, let's say 10, 12% a year. And you're taking risks to do that. And the other part of your portfolio is getting bond type returns, which back 4 years ago was nothing. Today it's 4%, but it's still nothing. And I said, there must be a better way. So I spent the last 4 years working on a methodology that would allow me to create a portfolio that, one, managed risk without sacrificing returns, and then two, made it available to the average investor. You didn't need to be a qualified investor. And in fact, the ETF that we launched is currently trading for about $25.50 a share. So if you got $25, you can participate.
Yeah, it's the beautiful thing about it. Beautiful thing about the ETF. And we're definitely going to get into your ETF and probably more so into your methodology today. But before we, get into the nitty gritty, I always like to ask, what do you do when you're not behind the desk? Any hobbies?
Well, I was born and raised in New York and moved to Texas to get away from state and local income taxes. So here I am living on a ranch between Austin and Houston, which if you haven't ever been here, it's actually quite beautiful. The people are friendly. I breed longhorns on my property, which is they're wonderful animals. They're beautiful to look at, and but they're a large bull can weigh 2,000 pounds, so you got to manage risk in just having a herd like that. When I'm not doing that, I play golf with my wife, and I'm pretty focused on ranch to table cuisine. We grow a lot of our vegetables and fruits, and we harvest fish and deer and beef, obviously, from our ranch and serve it to ourselves and our friends.
Love it. It sounds like a great life, and something I aspire to do one day is, have a ranch, grow my own food, and hang out and play golf.
Yeah, it's not a bad living.
No.
And you'll be very jealous to know that the golf course we play on a busy day has maybe 40 players.
Okay.
So there are no tee times. Start wherever you want, end wherever you want. It's a pretty great way to play golf.
Yeah.
Oh, and by the way, it's also just been ranked the best new golf course in Texas and in the top 5 of all golf courses in Texas.
That's
it's
great.
Just around the corner from us.
I might have to come down and visit.
That would be great. I'd love it.
So let's jump right into the ETF and some of your philosophy, because that, to me, I think is going to be most interesting to a lot of our listeners. You brought up a good point. Most equity investors are trying to diversify away from risk rather than to manage risk. So I think the best way is just start with the philosophy of the ETF. You guys have launched ticker EMPB, which is NextGen's Efficient Market Portfolio Plus ETF. It is a long-short equity strategy. So can you just dive into kind of a high-level overview of what this fund is trying to do?
Unlike almost any other investment, we are actively managing the risk, specifically the systemic risk. So all diversified portfolios are managing company or idiosyncratic risk by having lots of companies in your portfolio. And they're all managing sector risk by having multiple sectors in your portfolio. And that's appropriate. And it was born out of the work done by guys like Forma and Markowitz and Sharpe back in the 1950s. And then the only way they could manage the overall risk of the portfolio is to blend asset classes, low risk asset classes, low risk, low yield asset classes with high risk, high yield asset classes. But technology has changed in the 70 years since they did that work. And I took it upon myself to take a deep, dark look into it. And what I found is that the market predictability on an individual level is, and I would agree with Forma. I mean, nobody knows what's going to happen tomorrow. Nobody knows really what's going to go up or down. So what we took the approach is that we wanted to use pieces of the equity space as a hedge, since all of the various different industry sectors are reasonably well correlated. That is typically 70% or higher. And we said, can we find a way to use the industry sectors themselves as a way to hedge the systemic risk? That is, when it's a risk-off trade and everybody is selling everything, how can we risk that? And so the idea was actually born out of an observation made by a fellow whose name is Charles Ellis. He chaired the Yale Endowment Fund for a number of years. He wrote a book called Winning the Loser's Game. And on page 25 of his book, he points out that if you bought and held the S&P 500, your dollar over a 10-year period would grow to about $5.59. But if you missed the best 90 days, I mean, think about that. There's roughly 2,500 days in 10 years. But if you missed the best 90 days, your dollar would shrink by 22 cents to 78 cents. And so he made that as a very strong argument, which the whole world is still embracing, that buy and hold is the only way to go, because you can never predict which of those are going to be the 90 days, right? But then he went on to say, to me, the most astounding thing: if you miss the worst 90 days, your dollar would grow to $43. Think about that. Think about how punitive those worst 90 days are. And so I looked at this and I said, he's identified the low-hanging fruit. We're not going to try to be smarter than the market. We're just going to try to be less stupid than the market. And there's no way we're going to figure out which days are the bad days. But if you think of the S&P 500 as a horse race and think about which industry sectors are going to be in the back half of the pack, the nags of the market, if you will, maybe we can do something with that. And so I did what I call a crystal ball analysis. I said to myself, let's just take oil and gas, for example, XOP. If I knew next month that XOP was going to outperform the S&P 500 or the other way around, And I got to, with the crystal ball, if I knew that, so I always owned the one that performed better, whether or not it made or lost money, but I always performed the better of the two assets. Well, if you bought and held the XOP, the period under the study was 13 to 2023, you would have had a compounded loss of 2.5%. But if you had the crystal ball, you would have made 63%. Think about that. 63%. So I invented what I call a foggy ball. It's not perfect. It's statistically driven. It uses momentum indicators, and it uses what I call edge of the envelope indicators. So you just think of Elliott wave analysis, and I use many of them because I want to cover many time frames. Well, when I use my crystal ball, and I do what the algorithm says, I raise returns from a negative 2.5% to about 24%. So I capture roughly a third of the opportunity. It's not perfect, but it works. And when we couple that with a portfolio of 16 ETFs where the foggy ball works reasonably well, and we balance that portfolio so that we get a risk reward structure that we're comfortable with, we're basically targeting a Sharpe ratio in excess of 2 and returns that beat the S&P 500. We weren't trying to maximize returns. We're just trying to find that great balance that, I don't ever want to experience a 10% drawdown. And from a model perspective, we've achieved that. As we go through life and we see what happens in the real world, we'll find out. My models are models, all right? They're not the real world. But we launched in December, and so far, so good.
Yeah, so far, so good is right. I mean, we're recording this in the middle of April, and as we all know, we've had a ton of market volatility. You guys have done exceptionally well in that volatility. The drawdown is basically non-existent in the portfolio. So first of all, congratulations with that. You said a couple of things there that I have some follow-up questions on, which is I use this analogy, the best 90 days and the worst 90 days all the time. And it's astounding to me how if you just eliminate drawdown, you can end up with a better result. In your statistical studies, since you've done this as well, I think it's probably good for the listeners to know. Do you generally find those 90, best 90, worst 90, highly correlated in the same areas, just trying to miss the bombs? Or do you find that they're very hard to predict and can be, come out of nowhere?
Come out of nowhere. They're absolutely fat tail events that just you just never ever know when it's going to happen. And I think that that observation pays homage to the Nobel Prize winning greats that founded what most people use to manage their portfolios today. I mean, these guys. The interesting thing about that is that they in the 1950s when they were doing this work. Nobody had the data before then. Then the CRISP came along and spent a couple of years pulling all of the data from all the companies since 1926, making this data available. And then all of a sudden computers were available to analyze this huge volume of data. And so, Markowitz, Sharpe, and Forma, they were the first guys to ever look there. Forma himself said, it didn't matter what we did. Anything we did was new because nobody had ever had the opportunity to do it before.
It's great. I also want to talk about the indicators or the decision-making tree a little bit. So you're using an array of different indicators to kind of come up with, is it weighting decisions? Is it positioning? I know this is long, short, and I'll get into that, but are you coming up with a derived score, which then indicates how big you want your bet to be or where you want your bet to be? Can you just talk a little bit deeper about the system in and of itself? You don't have to give away the black box at all, Wayne,
right.
But just a little bit more information.
Yeah, I got it. I developed a proprietary method of analyzing individual ETFs, not individual stocks. Individual stocks have too much noise in them. I don't think you're ever going to get there with individual stocks. But things like industry sectors or themed ETFs that's focusing on a subsector of an industry, those all are potential candidates. So the first thing we do is we run it through our algorithms, and we look for patterns. All right, and if we can find patterns that we have confidence in, then we kind of begin by saying, well, based on what we're seeing here, we're going to start with this portfolio of these. Right now, we're using 16 different ETFs in our portfolio. And now what we're looking for is, some of them duplicating the work. Like, are they remarkably the same? So having two is the same as having twice the allocation to the one. And so we have to identify a portfolio of ETFs that are suitable candidates. Then we take that portfolio and we take that group of ETFs that are suitable, and we start to create, through an iterative process, portfolios that we believe are going to work, and then we fine tune that. So finally we get, we started with the one we have now, Efficient Market Portfolio Plus, EMPB, because it appeals, in my mind, it appeals to new investors, those that are just starting out and really don't want to take a big hit, even though they have another 40 years of earning power ahead of them, and those at or near retirement who absolutely do not want to suffer a setback because they have no earning power going forward. So we have portfolios that on the drawing board that are themed and they perform as well, and we have long only that perform as well, but they all have slightly higher risk components. And I think they'll be attractive to investors at some point in the future, because no matter how you tell people that don't try to time the market, everybody tries to time the market. And I can envision a world where there will be a bunch of people that say, okay, I think the market's going back up now, so I'm going to go in the long only portfolio. Oh no, I'm a little bit nervous here. I'm going to go back to the long short portfolio. And God bless them. I know they're both going to work well. It's just a matter of how much risk you want.
Yeah, I sit on that side of the fence where I talk to advisors all the time that tend to want to buy long short or CTAs or hedge fund like replication after volatility, and then want to get long only, or in the most recent case, just want to buy the Mag 7 as we get later down the cycle.
If you had bought the Mag 7 before the peak in 20, it would have taken you 3 years to get back to break even. 3 years. Oh, how painful would that be? Not to mention the fact that you lost 50% of your money.
Yeah, it was painful. But hey, that is human nature, and what guys like you and others try to have, computers and systems and strategies to try to eliminate, because I am done are my days, and I'm sure done are your days of trying to figure out what the market's going to do and time it and try to be in the right place without the help of the work that we've put in and able to allow our system to be able to help make those decisions for us. So I want to talk a little bit about the short component, because we haven't had many long short funds on the show, and I think it's an important part to investing that often gets overlooked as maybe too risky for investors. But in reality, it's a way to kind of dampen overall volatility compared to just diversification alone. So how does EMPB use short positions to actively manage systematic risk rather than try to diversify its way out of it?
Right. So the reason for including shorts is founded in partially economics, but mostly in performance. So with the portfolio that we're currently using on a pro forma basis, we do not have a 6-month period that lost money, and the biggest drawdown that we've had is less than 10% from peak to valley intra-month. So it's really it's an incredibly stable platform, and it's stable in another way too. So, for example, if you look at the first 88 days that our fund has been trading, the S&P, it's had a rough patch, as we all know, and it's had about as many losing days as it's had winning days, and those winning days, those losing days, are actually, because we're down, obviously larger than the winning days. So if we look at the winning days, there's the S&P made approximately a cumulative gain of 40% if you summed up the gains on all the winning days. And if you look at us, because we're long short, we only generated 24%. So on the long days, the S&P beat us by 14%, 16 basis points, 16%. But we're still capturing about 2/3 of that gain. But the winner here, and this is why you want to have shorts in your portfolio, when you look at the losing days for the S&P, it lost a cumulative 54%. We only lost 22. So we did not suffer 32% of losses that people that own the S&P 500 suffered. And so it's not that we're making more money, it's that we're losing less money. And by losing less money, we have a much more stable product. So it's not, you're sleeping at night, you're not worried about losing 50% of your money. It's and we just discovered that by focusing on industry sectors and building an algorithm that works, that the algorithm is actually pretty good at figuring out which are the nags of the market. And I will tell you, in the years we were beta testing this thing, there were many times the old, fundamental analyst in the back of my head stepped in, or some news item swayed me, and we would deviate away from the guidance of the algorithm. And in every case, we paid the price. And after about 10 in a row losses of making that mistake, we don't do that anymore. If the algorithm says this is what we're supposed to do, that's what we do. So it's another reason for these shorts too. I mean, obviously, if you're long 100% AUM and then you're short 50% AUM of highly correlated things, the product is going to be more stable. But what that does in a net long fund like ours, I mean, now all of a sudden people that have IRA accounts can own this because the fund is net long. They couldn't otherwise have the shorts in their account. Those shorts as an ETF generate funds that sit in our account. So if you look at our website, you'll see that we're long 100% of AUM, we're short 50% of AUM, and then it looks like we're 50% cash. Well, that's the money from the shorts. We're currently earning over 4% interest on that, which goes directly to investors. And so now all of a sudden we're getting paid for holding those shorts. So, and the 50% ratio, while the sweet spot is really between 40 and 60%, the 50% ratio is important because the collateral of the long position collateralizes the short position. So unless there's a negative mark to market on the shorts, there is no margin expense. It's just a tremendous opportunity to take advantage of of the rules of the game. And I should point out that if we have a 50% hedge, it's perfectly hedged. Then if the market falls by 50% from 100 to $50, it has to rally 100% to get back to 100. And then we have a perfect hedge. So it falls from $100, half as much to $75, and then it rallies half of 100%. It's going to rally to $112.50. So all of a sudden we're beating, after one cycle, we're beating the SPY by 12.5%. The only way that formula gets to break even is if the underlying rallies by 200%. And we know that almost never happens. And so with a long short program, if we can go through multiple cycles where we at least have a very high level of confidence that on average we're going to have a 50% hedge, all we have to do is go through 3 or 4 cycles and we're going to be way ahead of the SPY. That's just the way it is. And these cycles aren't just cycles over months. They're within the week. They're day-to-day cycles. I mean, it's actually quite remarkable how efficient, and it's simply the math.
So Wayne, you said a couple of things there that spurred a couple of additional questions. One of the funny things you said is, I've overrid the algorithm 10 times and I was wrong 10 times. I used to joke, it's better to make that mistake than to override it 10 times and be right 10 times. Then you think you got it. You don't need the computer anymore.
Yeah.
As I hear you talk, this is, to me, extremely hedge fund like, accredited investor like, and not generally acceptable or not generally accessible. I'm sorry. To retail investors, to everyday investors, or to somebody who's not accredited. So what made you and the team decide to launch this as an ETF rather than just peel it into a limited partnership and 2 and 20 it?
So I ran a hedge fund in commodities back in the early 2000s. It traded natural gas liquids. So I have experience in running a hedge fund where you go out and get qualified investors. It never got huge, but at one point we had over $150 million invested. What I really wanted to do was create a product that the the dental assistant in my town that's trying to save for retirement or maybe for her kid's college. And she knows that leaving it in the local bank at 1% isn't going to get her there. And she brings up that she doesn't really know what she can do to get better than this. And if you look at some of these regional brokerage houses, they don't really serve these people very well, in my opinion. I won't mention any specific names, but I just thought that you have open source platforms like Charles Schwab and Fidelity and Interactive Brokers and a lot of the new up and coming ones. I'm not familiar with all of them. That anybody with $100 can get a stock account. Well, now if you got $100, not only can you get a stock account, but you can have a seasoned professional that is run, who's designed, developed, and is maintaining a very sophisticated trading strategy at your fingertips. And all you need is $25. And I just it's going to be hard to sell that to a lot of people. I can tell you, I was very disappointed when we go out and we talk to RIAs that are managing 500 million or billions of dollars. They won't touch this. Why? Because as soon as their people see that they can do well with this, then why am I paying you a fee? I'll just buy that and forget about it. And I was a little bit disappointed at the barriers to entry that we've encumbered, but we're going to persevere, and I think the performance ultimately will speak for itself. And as I mentioned to you earlier, we just had a great review in Seeking Alpha on our product, and very pleased that somebody stepped up to the plate and said, "This is a different product. You need to take a look at it."
Yeah, no. If for those of you who, I just read that article before our show. It's a great piece. So I would go to Seeking Alpha to check out that write up, and it does a great job of kind of explaining what the product does and how stellar it's been. And you're right, barriers to entry are very difficult. It's time and patience, and the performance of the product is kind of going to do its job for you guys over time. As you go through different cycles. I think the one thing that a lot of advisors are going to kick back on is that advertised expense ratio, right? The advertised expense ratio shows a 2.21% expense ratio, but you and I have had some conversations that's a little bit misleading. And so can you kind of clarify how some of these offsets can work and what that expense ratio really kind of looks like?
Sure. The guidance from when we registered this is that you have to report the fees you charge, which we charge a 1% management fee. You have to charge the associated fund fees because we use ETFs. They have fees in them. And so we have to estimate what those fees are going to cost over the course of the year. And that's about 35 basis points off the top of my head. And then you have to, because we have short positions, we're required to pay the dividends on those short positions. And so it was determined that on average, we're going to pay about 85 bips a year on those short positions. So you got, that gets you to 220, not 221 that's reported. But what they didn't or haven't yet, and we're contesting this now, but what they're not letting us report is the net to investors across the total AUM, the interest earned on the short positions is going to equate to about 1.7% a year. I mean, that automatically makes almost all of it go away, and we're still making dividends on the long position. So they were making us report the money we lose or pay on the short positions, but we're long twice as many, and they pay about the same dividends. And so the dividend is not an expense; it's a credit. We think that if you go to Morningstar, they're reporting adjusted fund fees at about 1.35%, which is a number I can live with. But I think we're actually going to, in this refiling, get that reportable number under 1%, which is, in my mind, higher than the customers are actually going to pay once we get the benefit of these other pieces. But it's, you can't, you just got to work within the system. And, fortunately, and in some ways, I think it's one of the reasons why others don't have more long short funds, because they don't want to have to put out that expense ratio. So I see it as an opportunity to grow my business before people wake up that whatever it looks like, it's the smartest thing you can do because it's the best thing you can do for your investors.
Yeah. And also, I mean, you got to pay an expense ratio for active management and smart strategy as well. So, I mean, not everything can be 10 basis points and basically free. That's the other thing I wanted to talk about, which was that I didn't cover when we were talking about kind of how the portfolio works. Are you trading this on a daily basis? Is there a weekly, a quarterly, a monthly? Like, how often are you rebalancing the portfolio? Are you in there every day?
Monthly. And it might change subtly during the month because of creations and redemptions. But if you go to our website, nextgenemp.com, and scroll down to the bottom of the front page, you will see our actual holdings every day.
So kind of one of the last questions here, which would be, you're out there talking to somebody that's doing ETF model portfolio construction, or you're talking to advisors. They have a portfolio already put together. Where are you advising, or where would you recommend an allocation to EMPB in an already diversified model portfolio?
In an already diversified portfolio.
So the question was, will this, maybe to make it more simply, do you see this as an alts exposure? Do you see this as a complement to already, an existing large cap equity exposure? Like that, they like to talk in buckets. What bucket are you putting yourself in? Or I know you don't. I know it's a kind of a go anywhere a little bit, and it's a trickier question for you. But
we designed this to be your equity exposure solution. Period. If you think you need to add gold or Bitcoin to that, or ours is domestic or foreign exposure, God bless you. You go do that. We're not focused on that. But typically we hold anywhere from 300 to 500 different companies in our long portfolio. So we are diversified and we are managing it. And so I had a friend from town approached me who was very disappointed with the way their account was being handled recently. And to make a long story short, she didn't like having on a $200,000 account, did not like having a $3,000 drawdown. And I said, all right, this is what we're going to do. Since I think my EMPB is unlikely to have a 10% drawdown, we're going to put $30,000 in EMPB, and then we're going to put the other 170 in T-bills. She's 75 years old. And if I get this completely wrong and you lose your 10% on EMPB, you're going to wind up making something like 1.5% on your money. You're still going to make money, but if I get it right, you're going to wind up making close to 7% on your money. And I said, but you should never, you should, with the interest you're earning on the treasuries, I don't think you're ever going to see a $3,000 drawdown. And by the way, I'm managing your money. So if we need to stop it, we can stop it. So that's, what I want people to take from this is whatever you're investing in, you have to think about how much money can I lose? Most people start out with how much money can I make? Don't start there. Talk about how much money can I lose and make sure that you never lose more than you're comfortable losing. If you do that, you're off to a good start. Now, if you're like me, when I was starting out, I was busy in my commodity business, and every time I stepped into stocks, I said, oh, this will work, and I don't want to lose more than that. And I didn't lose more than that, but I lost that over and over and over and over again. So I finally got tired of hitting my thumb with the hammer and said, I have to come up with a better way. And so this is the better mousetrap that I believe I built. And I hope you all are willing to take a look at it and consider including it in your portfolio. And with this woman I was just talking about, I said, in 3 to 6 months, we'll visit it again. And once you get comfortable with it and have made some money in it, maybe you want to go up from 15% in equities to 25 or 30%. But the bottom line is, however much money she has in equities, she knows what a risk profile looks like. And that's where I think that's the next generation of investing in equities. I mean, once people figure out what I'm doing and it works, there are going to be a lot of lookalikes come along. Some of them will be charlatans, but other people are going to do just as good as I've done. And there'll be a great opportunity for people to invest with more confidence and less risk.
Well, Wayne, I really appreciate, your time with me. I appreciate your insights and your knowledge. Before I let you go, where can people go to learn more about the firm and your ETF EMPB?
So our website is www.nextgenemp. That's nextgenemp.com. Efficient Market Portfolio, EMP, it's in homage to the giants that created the industry that we all enjoy. And basically I'm standing on their shoulders to see further into the future. And it's if you go there, you'll see our bios, you'll see the current portfolio. It has a link to our registered investment advisory firm, and my telephone number is there. So if you call me, leave a message, because you call me, I'm not going to answer the phone because you're not in my phone. But if you call me and tell me why you called, I'll call you back. That's blame telemarketers.
Yeah, I'm the same way. Well, Wayne, again, thanks so much for spending some time with me. I look forward to, hopefully running into you and spending some time face to face in the future.
Well, I want to make a point of doing that, and you should come here and play golf sometime. You would love this course.
Yeah, I'd love it. All right, Wayne, thanks so much.
Thank you very much.